Good afternoon, everybody, and thanks for that introduction. I am Marty Connaghan, and I am one of the co-portfolio managers of Moray International Trust. I've been with Aberdeen for 26 years, in its various different guisings, and in its current misspelling. So I've been there for a very, very long time. It's a pleasure to be here today. What I was planning on covering was just covering some of the issues that all of us, I think, are trying to contend with at the moment in terms of investing. Just some of them. We only have 20 minutes, so I'm not going to go through everything, but just touch on some of the highlights and some of the things that we've been thinking about. And then feeding that into the trust and some of the things that we've been doing to try and navigate some of the issues that we're all facing as investors before hopefully leaving a little bit of time for Q&A at the end. So we're going to start with the outlook, which, if that slide was being really, really honest, we're starting with the bit that we really don't know. You know, if we think about 2023, that was definitely a year of, quite synchronized disinflation, but quite divergent levels of growth. We had India, we had the US performing quite nicely. We had the UK, Europe, China, less so. So synchronized disinflation, but very, very divergent levels of growth. In terms of the expectations for this year, we've certainly started the year with regards to a consensus forming a view around that we get a sort of soft landing, and then we move into an easing cycle with regards to interest rates. Now, the chart on the left is showing you GDP forecasts, ranges of GDP expectations, and then the number of forecasters where they are laying their bets, those brave souls that try to predict how much an economy is going to grow. And you can see that consensus is currently for, below potential, but for non-recession rate growth in the US. That would be quite an unusual thing to pull off. There has been 7 tightening cycles in the last 40 years. And in all but 2 of those occasions, we ended up with recessions. 83 and 84, when rates actually went to above 11%. That was a real rate of 8% at the time. And then they did it again in 94 and 95. But every other tightening cycle, there has been a recession. But consensus for now is saying that they're going to pull this off. The chart on the right side is then forecasting interest rate expectations in the United States. Now, this is a bit of a moving target, so bear with me here. But there is pretty much 25 basis point cut by May, pretty much priced in at the moment. But there are really wide views on this. The economist Apollo yesterday or this week was actually out saying that they do not expect any rate cuts in the United States. They view that the resilient growth is going to start heating up and they're not going to get the chance to cut rates. So the market is expecting rates. Some people are saying no rate cuts. What's in the price at the moment? That's what's very important. And in my view, the market has got a very, very blue sky scenario priced in at the moment. And the honest answer is, we really don't know. We've been also thinking about some things that could pause the timing of rate cuts or slow the cadence of rate cuts. And I think the sort of current goings on with regards to maritime shipping disruption is interesting. You can see the impact that that's had with regards to shipping costs on the left-hand side. We don't actually think that this problem is going to persist. The reason for that being that, global goods demand is currently below trend at the moment. And as the right-hand side of the chart shows, lanes in Asia with regards to freight are far, far more important. The only thing I would say with regards to that is we should definitely be keeping an eye on the geopolitical tensions that are present in that part of the world, because that is going to be potentially far more disruptive. So again, this is a part that we don't know. I'm just letting you know what we're currently thinking about. Another thing that we are talking about And whether you actually believe that we get back to the magical stated target of 2%, why it's 2%, I've got no idea. Why we have got some God-given right to get to 2%, I too have no idea. But what we do think is interesting is, and we believe is more likely, is the chance of more volatility within inflation. So the left-hand chart shows you the great moderation, low inflation, low volatility in inflation that we've had for the last 10, 15, 20 years, and then what's happened more recently. We think that geopolitical tensions, we think that supply chain disruption, we think that the changing nature of, or the outright reversal of globalization has the chance to make inflation volatility more relevant than it has been for the last 15 or 20 years. So all we're really saying here, and what the right-hand chart shows, is the impact that that can have with regards to bond yields. I don't necessarily believe that we're going back to a land of no rates or low rates everywhere indefinitely. We think that we're going to have continued bouts of the inflation volatility that we've seen, and therefore tightening cycles to deal with it. Not necessarily to the scale that we've seen, but not where we've been out of the GFC up until the last couple of years. So that's a lot of things that we don't know. And we like to focus on things that we do know, or things that are far easier to judge or to quantify. And you're going to have to bear with me here, but one of those things is dividends. Now, I know everybody thinks dividends are boring, but we like them because they are far easier to forecast. They're far more reliable. And as this chart shows, they are significant. The reinvestment of dividend income across most markets over the last 20 years makes up about 50% of your total return. So dividends are not to be ignored. I also like dividends because they are sizable. There was $3.5 trillion of dividends paid last year. They grew at 3.5% in the fourth quarter, year on year, last year. And they're resilient. This chart shows you that they are resilient. Dividends have never vanished everywhere, in every geography, in every industry, all at the same time. When capital goes, when markets fall, few hiding places. If you think about the GFC, absolutely, dividends and financials got crushed. If you think about COVID, dividends in the UK were down 40%. Dividends in Europe were down 30%. Dividends in the US were actually flat to slightly positive. So they are resilient. They're resilient, they're largely knowable, they're sizable, and over time they matter in terms of total return. So in a difficult environment, we do think that having an allocation to something that does give you income, whether you need that income or reinvest that income, is important. Murray International Trust is a large global equity income trust. It's tasked with delivering an above average dividend yield. The current yield on the trust is about 4.5%. We look to cover the dividend, i.e. to cover the dividend from the revenues that we receive from the underlying businesses which we invest in on behalf of shareholders. We try to grow the dividend in real terms, and we try to grow the capital in real terms over the long term. So we've grown the dividend for 19 years in a row. We've grown the dividend ahead of inflation in 15 of the last 20 years. RPI's posed somewhat of a challenge the last couple of years for us. The compound annual growth in the dividend over those 20 years is 7%. And we've grown the capital ahead of inflation in 14 of those 20 years. And the annualized return over those 20 years in terms of the capital is about 10% per annum in sterling. Now, if you look at any global benchmark, global equity benchmark, over the same time period, the annualized return will be about 9.5%, 10%, so comparable. The difference with Murray International Trust is it's delivered a similar, marginally better return, but without investing in any of the Magnificent Seven. So I think there's a call for us to be a little bit different. We all know I'm not short of, and you're not short of, stocks which can run very, very fast and very, very hard at times and can deliver capital. I think there's a case for having something different. They've delivered the same level of capital per annum over 20 years, but without touching the Magnificent Seven. Brilliant businesses, but they just don't help me deliver that investment objective. I can't have 15% of the fund in stocks that don't pay dividends, or else I won't deliver the investment objective. So that's why we avoid them. To have a different output, we have a different looking portfolio, and I think being different is important. So rather than having 60-odd% in North America, we have a pretty even spread between the major geographies, between North America, between Europe, and between Asia. We also have the opportunity to invest in fixed income securities. That's an allocation that we make opportunistically at times. It has been as high as 18%. It is now currently in 6%. We also have 12% in Latin America at the moment. Likewise, at the industry level, yes, we have a reasonable absolute allocation to information technology. Why would you not? But we also have allocations to good quality healthcare, industrials, consumer staples, and energy stocks. Again, trying to offer shareholders something different. We do not want all of our investments dancing to the same tune. It's the same with the stocks in the portfolio. Now I've got a question for you. If we were to break down a global index, so we'll say FTSE All World, in my time in the industry, so going back 26 years, into its major regions, so North America, Europe, Asia ex-Japan, Latin America, UK, etc. Which region has been the best performing the most times, and how many times? So hands up if you're thinking North America. Okay, it's Latin America. 11 times in the last 26 years. People ask us why we invest in Latin America. That's why. I'm not saying don't invest in North America. You've just seen that we do. But Latin America, there are some phenomenally well-run businesses. You have to be careful. You have to do your homework. But that's the same with any market. It's no different. You can find very well-run businesses in Latin America, as we can in Asia and Europe and North America. And I'm not going to say anything about the UK. I think another thing for all of us to keep in mind that the top 10 sort of replicates is it's really worthwhile to have a balance of conviction and diversification. So there's growth there, there's value there, there's high yield, there's low yield. We can, and where we can get a level of dividend yield, we will expose ourselves to some of these tech companies that have done very well. But we have Grupo Azur, a Mexican airport company, fantastic assets. If you've ever been to Cancun Airport, you've been in their key asset. Different businesses, AbbVie, manufacturer of Humira, this is a key drug, but also the main manufacturer and distributor of Botox and fillers, of which I'm obviously an avid consumer myself. We Glaswegians, we don't age too well, so it's a necessity for me, I'm afraid. Financial companies, there's a real mixture there, and again, the key thing we're trying to get across here is just something a bit different. Another thing for us all to bear in mind at the moment, when we're making changes in the portfolio, we like to keep turnover low. We don't like trading for trading's sake. This is an example of a company that we sold recently. No turnover is fine, but by the same token, just because we've held a stock for 19 years doesn't mean we should hold it for the next 19 years. Now, Taiwan Mobile, an excellent annualized return over 19 years. So why did we sell it? Why do you invest in a telecom stock? You're there for the income. You're there for the growth in the income, and theirs had started to stagnate on the left-hand side of the chart there. Nothing wrong with the company, it's just been buying businesses. The Taiwanese mobile market's going from 5 carriers to 3. They've just bought T-Star. They've been bidding for 5G spectrum, so the dividend's stalled. As the stock's done well, it's got more expensive. The rationale no longer makes sense, so we sell out. It's done its bit, and we move on to the next investment. And I think it's always important for all of us to continually appraise our investments. We should also feel comfortable about taking a look in some of the areas of the market that have been weak, whether that's China or whether that's some of the staple stocks here in the UK and Europe. And this is a recent addition that we've put into the portfolio. Latin America and the Caribbean is absolutely slowing down. You know, it has been tough off of very difficult comps as we came out of COVID. But we still like the breadth and the strength of those brands. We still believe in the Scotch whisky market internationally. We believe in the opportunity for the business to, you know, expand margins in Asia and to take some of the tequila brands that have been so successful in North America and take them across the globe. So this is what's happened essentially. You have COVID. Now, I was locked up with my 4-month-old at the time, so I can assure you I was doing my best to protect these volumes. But you then have the COVID or the post-COVID party. There was always going to be a slowdown to be had. And that's where we're at the moment. But consensus is clearly not expecting it to be broken and expects it to get back to delivering mid-single-digit growth. Yet we don't believe that that is in the price. So we think Diageo, looking for opportunities that are different and have been weak. You've always got to look for opportunities there. And given that it was International Women's Day yesterday, do we like the fact that Diageo's CEO, CFO, Chief Marketing Officer, Head of HR, Head of India, Head of Europe, and Head of North America are women? Of course we do. It's a fantastic thing. So in summary, the outlook, who knows, frankly. I've just given you some of the things that we've been discussing, but these are things that none of us can truly know. I think in that environment, we want to stick to things that we do know or that we can understand. And in that, I think dividends and income and yield are worthy of consideration. I think having a portfolio that's slightly different is worthy of consideration also. And when it comes to changes to your own portfolio, low turnover is good. High turnover is necessary if markets give you the opportunity. And always look for opportunity amongst the weakness, which is what we've been doing at the moment. I'm just going to stop there. I really appreciate you coming along, and I'm happy to take any questions, or we're out next to the stairs if you want to come and catch up with me. But that was all I really wanted to say. Thank you.